Welcome everyone to another episode of Small Business Treasury. And today I want to talk about what does the Treasury team look like on the weeks and the week and the day of leading up to an M&A acquisition, right? So as a growing organization, your company may be growing through acquisitions or through organic growth, but a large portion of companies growing beyond the several $1 million in revenue, their growth happens through acquisitions, whether that's a small acquisitions or a large acquisition. That depends on the type of organization. But the process for the Treasury team remains very, very similar, whether it's a $1 million organization or a $100 million organization. And I have a lot of experience in M&A when it comes to Treasury integration because I've done several acquisitions and M&A transactions in my organization as a treasury manager. And the day-to-day operations when it comes to an acquisition on a small scale or large scale is exactly the same. I've done acquisitions up to $2-3 million up to several $1 million and beyond 100 million, right? So those are the types of things that are you may think are different when it comes to the process, but the process remains the same. That is a very important distinction when it comes to discussing treasuries, because treasury does not change depending on revenue or company size. It remains the same regardless all the way across, right? So whether we're discussing the policies and procedures for an ACH transaction or a wire transaction, whether that's $1,000 or $100,000, the process remains the same. So same thing is applicable on the M&A side. Whenever there's an M&A transaction, we, the Treasury Department, have certain protocols and policies and procedures that we must follow to make sure that the transaction goes smoothly and that we're protecting the company's capital, right? So I'll discuss what the weeks look up to, the few weeks leading up to the acquisition, the week of the acquisition, and then the actual day of the acquisition, right? So on a new acquisition, the Treasury team, usually myself, is alerted by our acquisition team, our development team. They inform us that there'll be a closing and acquisition. Usually they happen at the end of the month. So the last business day of the month is when those acquisitions are usually closed, because on the next business day, right? So if it's a Friday, a Monday, on the next business day, they're operating fully under the new organization entity. Okay. Now, sometimes it's done where it's the last Friday of the month prior to the new month. So if the Friday is on the 27th or the 26th or whatever it may be, then you have the weekend and then you have some holidays. That's typically another way that it's done as well. So I've seen the most common is being on the last Friday of the month that closes. And then by the start of the next week on the new fresh month, the acquisition that was acquired on Friday is a brand new entity under the acquired entity or the of the parent company, right? So on the weeks leading up to the acquisition, the Treasury team is notified that we'll be closing this deal, and they inform us of a few different things. One, they inform us of the closing cost amount. So they inform us the deal size, right? Whether that's 2 million, 20 million, 40 million, 60 million. The team, the acquisition team, the M&A team, they inform us of the amount. Second, they inform us how that's going to be funded. Whether that's funded by our balance sheet or whether that's funded through our loans, right? At that point, the Treasury team is now responsible to take into consideration how this deal is going to be funded and to prepare for it properly, right? If it's being funded by our balance sheet, then we have to now put that into our forecast to expect that on this date, we are expected to draw $5 million from our checking account, or in our case, our money market accounts, to fulfill that obligation, to fulfill that closing of the merger that is being fulfilled on that day. Or if it's bank financing, then it's our job to now communicate with the bank and obtain additional details of the bank financing, right? So then we're going to discuss loan payments, amortization schedule, any fees related to the financing. When do we expect those funds to be available in the corporate account? What account is it going to be debited to, right? So all these things, as the C-suite and the M&A team, they discuss with the executive bankers on the actual deal structure and the loan amounts and all these things. On the second level, you have the treasury team who's working with their middle managers in the banking side to obtain the smaller details that we are responsible to be aware of, because as a treasury team, we're not only responsible for the making sure that we receive that capital from the bank or making sure we have the capital available from our balance sheet, but to make those entries into our accounting software, our ERP, to make sure that everything is being booked properly. So as a treasury function, a treasury manager, my job will be to go and obtain that information on the weeks leading up, so we're not waiting on the day of to obtain this information and to be reacting rather than being proactive. So on the weeks up, we're being proactive and we're obtaining this information from the bankers as once everything is said and done, once the paper is done by the executive team. So at that point, that happens, let's say, about 3 weeks prior to the closing. On the week of the closing, so beginning usually the Friday before of the day of the closing, so a week prior, maybe 10 days prior, our team, our M&A team, will give us a draft of all of the beneficiaries who will be receiving wires for that acquisition. So depending on the deal size is depending on the amount of wires that will be going out, right? So I've had situations where it's just 3 wires, 3 founders. Maybe it's 2 founders, a small employee, but I've also had wires where it was 16 wires, where it was a handful of founders, a handful of early employees, and then you have their employee shareholder plan, which is into one direct account that's handled by a trust or some sort of entity that handles distributions in that regard. So I've dealt with it. I dealt with it in a wide spectrum between just a handful of wires to 16, 17, 18, 20 wires for an acquisition close, just depending on the deal size. On that week that we received that, one of the final drafts of those beneficiaries of the wire distributions that will be coming on that closing day on that coming Friday, it is the job of the treasury team to now do verbal confirmations and verbal calls to all of the beneficiaries who would be receiving wires. So if it's 20 wires that are going out, we have to make 20 phone calls and say, hey, we're planning to close on Friday. Before we issue a wire, part of the policies is to make sure that we do a verbal call to ensure that we're sending cash to the right account, to the proper account, and do any other further verification. And that it's a very important step in the process. I've encountered so many different issues that would have been catastrophic problems had you not done those phone calls, because many times these individuals, these founders, they provide the wrong routing number. They provide incorrect account number. They're missing a digit. They provided the wrong address, right? So all of these different things that would not have been caught if it was not for the verbal call are caught in those verbal verifications on the week of the closing. So the week of the closing, the majority of the team, the treasury manager, is usually a treasury manager who's making these calls, right? Because it's a very delicate situation, so it has to be an experienced individual. This is typically not really done by an entry-level analyst unless they're being supervised. But the verbal verification is very, very important because you are verifying the individual's name, their address, the account number, the routing number, and if they go through an intermediary bank, then you have to address the FFC, which is further credit to, and that's a whole different situation. And most common when you see that is if you have an individual who's a founder who is being acquired by an organization, and part of their distribution for the acquisition wire payment is going to go towards their brokerage. So it could be an E-Trade, it could be a Morgan Stanley, it could be any type of those wealth management trade brokerage accounts. Many of those accounts do not have a simple routing and a account number. They have brokerage numbers. So you're basically doing an FFC, where you as a treasury manager, you're issuing a wire to the brokerage, and then on the details of the wire, you have to instruct further instructions as to who this money belongs to within the brokerage. So those are very, very important details whenever you're conducting M&A acquisitions on the week of doing the verbal verifications with all the beneficiaries. It's very, very important that you obtain those details, because once those wires go out, it's very difficult, very, very difficult. And I made videos about this in the past. Once a wire goes out, it's very difficult to get that money back. They are considered real gross settlements. So you are not be able to recover those funds. It takes a lot of lots of people involved to try to retrieve that capital, and it's very, very unlikely that you will. Banks are very, very clear on that. So it's very important that when you are doing the verbal verifications on the week of, whoever you're sending those beneficiaries of those wires, that you obtain all this information, you cross-check it, you triple-check it, and you make sure that you have all the information that's accurate. If there's inconsistencies or inaccuracies between what you received from your M&A team and from what is being discussed on that verbal call, you need to make sure that you do additional questionnaires within that call to further ensure that you are collecting the correct information, right? So many times you'll encounter situations where the individual put in the wrong account number. Maybe there was a typo. Maybe instead of a 3, they put a 2. And then you catch that. And then whenever I catch that, and it happens to me very, very often, I typically read it 2 or 3 times back to them to make sure that what they are seeing on their screen and what I'm reading on the new information that's being provided is accurate. So those verbal calls are very, very important, because it reduces your chance of fraud. It reduces your chance of being losing your capital. And as a business owner and as an organization that's growing, you want to make sure you have these policies in place, right? So maybe you don't have a treasury department within your organization, but you have a CFO who oversees the function. They need to be aware of these treasury practices so they can go ahead and make sure that they are implementing these things as the organization grows. So finally, on the week of, you're completing all those verbal calls and making sure that all of the beneficiary information is accurate and ready to go, to make sure that you are set to go on closing day on that Friday. On the days leading up to the acquisition, so maybe that Wednesday, Thursday, at that point, the treasury manager or the CFO or whoever's the head of the finance team, the accounting team, I refer to my in these examples from a treasury perspective, right? Because this is a treasury channel, and what you should be doing as a small business or a growing enterprise to implement multi-billion-dollar practices within your organization. So the treasury department at that point, on the days leading up, the few days leading up, that's when we begin creating the wire templates. Every single wire that we release goes through a wire template. We never do wires freeform. Freeform is I go down, drop to a wire, and I fill out the information on the day of, on the moment of, and then I issue the payment right then and there. That's a huge risk. Humans make a lot of errors on typos, so we always create wire templates. We have 3 people check the wire templates. We cross-check everything. We check it 4 or 5 times. At the end of the day, whoever approves it, usually the treasury manager. In my case, I approve those wire templates that are set up by my senior analyst. At the end of the day, the person who approves, they are signing off that they did everything, the due diligence regarding those wire templates. So the responsibility and the accountability falls on that manager. The analyst can set it up. They can make mistakes, but at the end of the day, the manager is the person who takes accountability if something goes wrong, because they're the person who is supposed to be responsible to making sure that everything is set up properly. So on the days leading up, I will have my analyst prepare the wire templates. They submit to me for approval. And then that's when I go in there and do heavy detail and check everything. I cross-check everything. The name, the address, the account number, the routing number, the FFC if it's applicable, the destination if it's not a U.S. territory, maybe if it's a cross-border, maybe it's Canadian, maybe it's whatever the case may be. I cross-check every wire to make sure that when I did those phone calls during the week, everything matches up properly, right? So these are practices that you as an organization should implement within your enterprise to make sure that whenever you're doing M&A acquisitions and you're sending wires to those beneficiaries, that you're following the practices of the multi-billion-dollar organizations, right? These are what multi-billion-dollar organizations do. They have 3, 4, 5 people check everything. They check it days in advance. They give themselves enough time to make sure that they're not missing everything, to make sure they're not rushing anything. So That's what happens on the days leading up to that Wednesday, Thursday, leading up to the acquisition day. And then Friday, you have your acquisition day. And at that point, you'll receive what is called a final funds flow from your M&A team. And the final funds flow is just simply saying, hey, the contract's been signed, the attorneys have signed off, everyone's in agreement, the CFO has agreed to proceed with the release of the wire. Then you're just waiting for the CFO to give the green light. And at that point, the Treasury team is going into the banking platform. They're creating the wire templates that were already made the days prior. And then they're issuing those wires, cross-checking the amounts, cross-checking the beneficiaries. Me in particular, even the day of, I'm checking every single digit. I'm checking every single account number, every single routing number, every single detail, every single address, every single name. Because even then, you want to make sure that you're always checking, right? Always checking. I've had scenarios where there was a mistake and it was caught on the last day on the final check, right? So my analyst prepared it. It was activated. The wire template was activated the prior. And then on the day of, I noticed there was a typo in the name on the day of getting ready to release those wires. So those are the things that I'm saying, that you're always cross-checking yourself. Your team is cross-checking each other. There's not one person responsible for the wire setup, wire templates, and then issuing the wires. That's a huge liability risk, man. Even people with 10 years of corporate experience, they make mistakes like that. You always want to have people. It's called segregation of duties, right? So in your organization, if you have a CFO who's responsible for M&A wires, and they're the only ones processing the initiation, the setup, the cross-check, the QA, and nobody's checking them, that's a huge liability risk, right? And the point of these videos is to make sure that you become aware of it, so you can go in there and you can fix it. Because once that wire goes out, if it's $3 million and it's going to the wrong account, you're unlikely to get that money back. And I don't say that lightly. I work at a $1 billion organization, and even to this day, my VP, myself, we are we have tight protocols and policies in place, because even at a company that size, losing $2-3 million is not something to laugh at. And many times the insurance companies that cover those types of fraudulent activities, if they find out that there was an error within your policy practices, they're not covering it. So if they find out that the reason why that wire went out, and the reason why it was to a fraudulent account, is because your Treasury department didn't have segregation of duties between someone who checks and QAs the wire setups and the template setups, the insurance claim will be denied because they didn't follow proper Treasury practices. That happens at a $1 billion organization. So at a smaller level, it's very important to have those practices in place, because it's very important for the organization who plans to grow to have these policies in place. Okay, and best practices in place. So on the day of, you're closing, green light, you're issuing the wires, and then at that point, you're just setting up the wire templates, putting them in the amount, submitting them for approval, and then releasing them once they've been approved by, in my case, the VP approves it, and then I release them. So in every step of the way, from the very beginning, the weeks prior, there's always a Q&A. There's always cross-check, whether it's between the Treasury analyst and the manager, or the manager and the VP, right? There's always, or in my case, the SVP, the senior vice president. So there's always a cross-check between me and my senior analyst, and then me and my SVP. And then you as an organization, you have to have those same practices in place, because that's what creates the safety, best practices. You eliminate risk, you eliminate human error, you eliminate the possibility of fraud, right? All these things are in place to make sure that you're protecting your company's capital. So anyways, the wires are released at that point. We receive the wire confirmations, we print them out on the PDF, we give them to our M&A team, and then they issue them to the beneficiaries, giving them the alert that the wires have been released and are ready to, they should be receiving it by the end of the day, if not on the following Monday. So that is what the M&A process looks like on a high level from a Treasury standpoint. And that's what I wanted to share, because I think these are very, very important practices for small businesses and growing companies to implement within their own enterprise. Maybe they're not at 100 million, but at $10 million, if you're doing M&A and you lose $1 million in an acquisition, that's going to hurt. That's not something to just take lightly. So these practices help eliminate that process, right? So if you want to learn more, just subscribe to the channel. I try to release these videos from, my 10 years in corporate treasury experience. I'm very passionate about this. So I want to just help educate the small business owner, help them become knowledgeable in this. If they can help implement these things on their own, like a DIY type of thing, then it'll help the organization become better. If they need expert advice, that avenue is available too. Just if you have questions, leave them in the comments so I can address them. If you want to speak to me directly so we can discuss your specific scenario, your specific question, your specific concerns, I'm doing free sessions. You just book a call and we can discuss that. My job here is to help you. I want to educate everyone, and that's all for today's video, and we'll see you all in the next one.